Friends, fellow investors, the stock market is a fascinating beast. It's a whirlwind of emotions, driven by fear and greed. But beneath the surface lies a language of charts and indicators that whispers secrets to those who listen. This is the language of technical analysis. Today, we'll delve into two powerful tools of this language, MACD and VWAP. These aren't just jargon, my friends. They are your allies, your guides in navigating the market maze. They can help you spot trends, identify buying opportunities, and ultimately make informed investment decisions. Whether you're a seasoned investor or just starting your journey, understanding MACD and VWAP can significantly enhance your trading strategy. So, buckle up, keep your notebooks ready, and let's embark on this exciting journey to decode the language of the market. Remember, in the stock market, knowledge is power. And today, we empower ourselves with the knowledge of MACD and VWAP. MACD, or Moving Average Convergence Divergence, sounds complicated, doesn't it? But trust me, it's simpler than it sounds. Once you get the hang of it, you'll see how intuitive it can be. Imagine two moving averages, like two cars racing on a track. One car represents the short-term trend, and the other represents the long-term trend. The MACD tells us the difference in their speed and direction, giving us a clear picture of the market's momentum. This difference helps us identify the strength and momentum of a trend, which is crucial for making informed trading decisions. The MACD has three components: the MACD line, the signal line, and the histogram. Each of these plays a vital role in the analysis. The MACD line is the difference between two exponential moving averages, typically 12-period and 26-period. This line shows the relationship between the short-term and long-term trends. The signal line is a moving average of the MACD line, usually a 9-period EMA. It acts as a trigger for buy and sell signals. And the histogram? It simply plots the difference between the MACD line and the signal line. This visual representation helps traders see the momentum at a glance. Now, how do we use this? It's all about the crossovers. When the MACD line crosses above the signal line, it often signals a bullish trend, a good time to consider buying. This crossover indicates that the short-term momentum is stronger than the long-term momentum. Conversely, when the MACD line crosses below the signal line, it suggests a bearish trend, potentially a time to sell or stay cautious. This indicates that the short-term momentum is weakening. Remember, the MACD is a lagging indicator. It tells you what has happened, not necessarily what will happen. This is why it's important to use it wisely. Use it in conjunction with other indicators and your own analysis. Combining different tools can give you a more comprehensive view of the market. By understanding and utilizing the MACD, you can enhance your trading strategy and make more informed decisions. Let's bring the MACD to life with a real-world example, shall we? Let's look at Reliance Industries, a heavyweight in the Nifty 50. As you can see from the chart, there were periods when the MACD line crossed above the signal line, indicating potential buying opportunities. Similarly, when the MACD line dipped below the signal line, it presented potential selling opportunities. Remember, this is just one tool in your arsenal. Combine it with other indicators and your own research for optimal results. Now, let's move on to our next tool, VWAP, or Volume Weighted Average Price. This is an essential metric for traders who want to understand the true average price of a stock throughout the trading day. Imagine a stock's price as a melody. VWAP is like the rhythm section, giving you a sense of the average price at which the stock is being traded throughout the day, factoring in the volume of trades at different price points. It helps you see the bigger picture. Calculating VWAP is like making chai. Just as you blend different ingredients to get the perfect cup, you combine price and volume data to get VWAP. You take the total value of shares traded at each price point, price multiplied by volume, add them up, and then divide by the total volume traded for the day. Simple, isn't it? This calculation gives you a weighted average that reflects both price and volume. VWAP is particularly handy for intraday trading. Day traders use it to gauge the market sentiment and make informed decisions. It acts as a benchmark, helping you understand if a stock is trading above or below its average price for the day. This can indicate whether the stock is overbought or oversold. Traders often use VWAP as a support or resistance level. When the price is above VWAP, it can act as a support, and when below, it can act as resistance. Remember, VWAP is a dynamic indicator. It evolves with each new trade, providing real-time insights. It changes throughout the day as new trades occur. This makes it a valuable tool for tracking market trends and making timely decisions. Keep an eye on it, and it can guide your trading decisions. By understanding VWAP, you can better navigate the complexities of the stock market and enhance your trading strategy. Now, let's see VWAP in action with another Nifty 50 giant, Infosys. Observe how the stock price often dances around the VWAP line. When the price is above VWAP, it indicates buying pressure. When it's below, it suggests selling pressure. Use this knowledge to your advantage, my friends. The dynamic duo MACD and VWAP in harmony. Now imagine combining the trend-following power of MACD with the real-time insights of VWAP. That's like adding a turbocharger to your trading strategy. Let's take HDFC Bank as an example. See how the MACD gives us a sense of the overall trend, while VWAP helps us identify potential entry and exit points within that trend. When the MACD signals a bullish trend and the price breaks above VWAP, it could be a good time to consider buying. Conversely, a bearish MACD signal combined with a price drop below VWAP might suggest a selling opportunity. Remember, this is just an example. Always do your own research and consider your risk appetite before making any trading decisions. Nifty 50, a playground for trend analysis. The Nifty 50, our very own barometer of the Indian stock market, is a fantastic playground to practice your MACD and VWAP skills. Look at the charts of various Nifty 50 stocks. Identify trends, spot potential entry and exit points. Practice makes perfect, my friends. The more you analyze, the more comfortable you'll become with these indicators. And who knows, you might even discover your own unique ways of using them. The Jhunjhunwala twist, contrarian thinking with MACD and VWAP. Now, here's the surprise element, my friends. While MACD and VWAP are powerful tools, remember that the market is a game of psychology. Sometimes, the best trades are the ones that go against the grain. This is where contrarian thinking comes in. Don't blindly follow the indicators. If everyone is buying based on a bullish MACD signal, ask yourself, is the market overbought? Could this be a good time to sell? Similarly, if everyone is selling based on a bearish MACD, could it be a good time to buy at a discount? This is where your own research, your understanding of the company, and your gut feeling come into play. Use MACD and VWAP as guides, but don't be afraid to challenge the herd mentality. Remember, the market rewards those who think differently, who can see opportunities where others see only chaos. Mastering the market's practical tips and conclusion. So there you have it, MACD and VWAP, two powerful tools in your technical analysis arsenal. These indicators can help you make more informed decisions and identify potential trading opportunities. Use them wisely, combine them with your own research and risk management strategies, and you'll be well on your way to mastering the markets. Remember, no single tool guarantees success, but a well-rounded approach increases your chances. Here are a few parting tips. Start small. Don't put all your eggs in one basket. Diversification is key to managing risk and ensuring that one bad investment doesn't ruin your entire portfolio. Begin with small investments and gradually increase your exposure as you gain confidence. This approach allows you to learn and adapt without risking too much capital upfront. Be patient. Rome wasn't built in a day, and neither are fortunes. Long-term investing requires patience and a steady hand. Be patient, stick to your strategy, and don't let emotions cloud your judgment. Emotional decisions can lead to costly mistakes, so maintain discipline. Never stop learning. The market is constantly evolving. New trends, technologies, and economic factors can all impact your investments. Stay updated, keep learning, and never be afraid to adapt your strategies. Flexibility and a willingness to learn are crucial for long-term success. Remember, the stock market is a journey, not a destination. Each step you take is part of a larger learning process. Enjoy the ride, learn from your mistakes, and most importantly, never stop believing in the power of smart investing. Mistakes are inevitable, but they are also valuable learning opportunities. Now go forth and conquer the markets, my friends. With the right tools, strategies, and mindset, you have the potential to achieve great success.